Good morning, Bitcoiners, and welcome back to your economic calendar, where we cover the news and analysis you need to start the week off right in Bitcoin. Today is Monday, August 9th, and as always, we have a jam-packed episode for you today. In today's show, we're going to start by talking about shrinkflation, which is at play and coming to a supermarket near you. We're going to discuss what it means and how you can watch out for it. We're also going to talk about inflation in the United States. We get a reading of July's CPI this week in the US, and we can look at some clues as how the US economy is recovering or how that recovery is going. And last but certainly not least, we're going to be comparing the US bond market with Japan's bond market. We've talked a lot about how the US is getting involved in its own Treasury bond market. And we're going to take a look at Japan to see how that played out and whether we can find any clues as to where the US might be heading. So, lots to cover today. Grab your coffees. It's going to be a good one. So starting as we usually do with Bitcoin, we see that last week Bitcoin had its third consecutive week of gains, closing up 10.09% at $43,858. We see that the rally seems to be continuing again this morning with some pretty positive price action already out of the gate in the early hours of today. Price action has been positive as of recently, and this could have to do with the fact that signs of inflation continue to flash around the economy. Last Friday's unemployment report showed spikes of wage increases in certain sectors, and we will be breaking down those later today. Now, the spotlight last week, over the weekend, and today has been on the US infrastructure bill, which has a crypto regulatory framework included as part of the grant or the larger bill. After a sleepless weekend, the bill has been pushed to a vote today. And there are still several amendments that are being proposed to the bill, and there is no real certainty as to which one of those will be voted or passed formally. So there could be some price volatility in the cards once this bill actually passes today or in the coming hours, perhaps not today, but tomorrow. Now, there were a few very interesting articles over the weekend. Namely, one was the one that you have up behind your screen, which is from Politico. And it basically, the headline reads, Washington wakes up to crypto influence amid infrastructure fight. And just based on this article and a few others, I wanted to highlight some of the narrative that's been building around the recent efforts and the exchanges between the crypto industry and politicians as this bill essentially was introduced. And it is that regardless of the bill's imperfection or the framework's imperfection, it is important not to lose sight of where we are today. The United States Congress had an open debate about a bill to regulate the crypto industry. The level of awareness that this brings to the industry cannot be understated. And the fact that there is a framework will now allow millions of new people to interact with Bitcoin and crypto companies. So we will continue to monitor the bill progression, and we will continue to share any details right here through our social media accounts. Now, besides this, we wanted to check in on a bit of an inflation update, or I guess an update on how inflation is playing out in the economy. So this week, we actually get a temperature check on US inflation as July's consumer price index reading comes out this Wednesday. We'll go through the details in our What's Ahead section as we always do, but it's out Wednesday. And June's inflation came in at 5.4% per year. With the recent upward pressure that we've seen in both wages and rent prices, as we highlighted in the last spec, it would not be surprising to see July's inflation reading come in line or higher than June. Now, before we go even forward, I wanted to highlight one correlation that we highlight here quite often, which is the Bitcoin correlation with the yield on the 10-year Treasury note. And if we just go to the daily and we see the price action from last week. Sorry, I think I put the wrong chart here. 1 second. Treasury note yield. Here we are. So the correlation that you have behind your screen, as we've highlighted here many times, is Bitcoin and the yield on the 10-year Treasury note on the US. Now, as you can see, they have both have been rallying together as of recently. And last week, as mentioning through this chart, both of them rallied higher on Friday after the jobs report. Now, of course, there were other factors at play influencing the price of both. But as we've mentioned here in the past, the yield on the 10-year note continues to track Bitcoin prices rather well. Now, on the topic of inflation, there are a few indicators that point to a potential for it to keep running higher. So potential for inflation to keep running higher. And one such indicator is the fact that monetary velocity in the United States still remains at record lows. The chart you have behind your screen right now shows you the monetary velocity for M1 money stock and monetary velocity for M2 money stock, which is two different ways of calculating essentially the velocity of money circulating through the US economy. One of them includes savings and investments and the other one doesn't. But as you can see, the point to highlight here is that no matter how you calculate it, they are both at record lows and showing no signs of rebounding just yet. Now, before we dive too deep into this number, it is important to highlight a very important consideration, which is that the way that the monetary velocity formula is calculated, it basically divides quarterly GDP over the M2 money supply. Because the growth of the M2 money supply has been so huge, and it has structurally increased by such a large magnitude, this means it'll take a lot of time for the GDP growth to essentially make up that magnitude and that velocity to start ticking higher, just because the number through which it's getting divided by, it's grown by such a high amount. So just keep that in mind. However, despite all of this, the potential for monetary velocity to increase is very real, and it would certainly put upward pressure on inflation. Now, the catalyst to speed up monetary velocity could be in the US labor market. This market has been picking up a lot of steam, and enhanced unemployment benefits are actually expiring in September, which could drive a lot of new people back into the workforce. This may be the spark that monetary velocity needs to put in a base and start rising. More on this in our next section on the jobs in the U.S. jobs market in our next section in the S&P. But before we move over to that, we want to talk about the other way inflation manifests itself in the economy. And this is another dynamic that is becoming more and more apparent. Basically, what happens is that companies don't want to raise the prices of their products to remain competitive. So what do? They make their products smaller. This practice is typically referred to as shrinkflation, and we have some beautiful examples here to show to you today. The images that we're about to share were actually shared in social media by Lynn Alden and some of her followers. So thank you so much for sharing this and wanted to kind of highlight these to you to see what shrinkflation looks like in the supermarket, and so that you can watch out for it as well. So first off is a picture here of Charmin. This is toilet paper, and as you can see here, it has gone from 286 two-plies to 264 two-plies. Keep in mind that all of these purchases were, the references made are that they were made within weeks or at most month apart from each other. So again, two exact same product, exact same price, just less of that product. This is not just true for toilet paper. You can also see it here on the M&Ms. M&Ms actually not only go down in grams per bag, but they go down in energy per serving, which is fascinating. And in addition to the M&Ms, we also have laundry detergent. Again, we see that this one goes from, where is right, so 943 grams, you can see here, it goes to 890 grams. So again, very interesting to see this shrinkflation at play. Though the long and the short of it is that as inflation is playing out in the markets, whether it's inflation or whether it's shrinkflation, the value of what you get in exchange for $1 basically has gone down, and it'll likely continue going down. So more on this, or more on inflation in our next section and our What's Ahead section later today. Moving over to our analysis of the S&P 500. Zooming out, first off, before we even get started, the chart for the S&P 500 looks like a dream. Like, the more you zoom out, the more it looks like a line that's just up, straight upwards and to the right. However, let's zoom in and take a look at what happened last week. Let's go back to the weekly charts. So last week, we see here that the S&P reached a new all-time high, closing up by 79 base points at 4,438 points. As I mentioned, the chart looks pretty rosy long term. Dow Jones also closed a brand new high of its own, up 78 base points at 35,208 points. The NASDAQ did not reach a fresh all-time high last week. However, we see that it did break one this morning. Last week was its second highest all-time high. So by and large, equity markets in the US seem to be doing really well. They're all pretty much, all major indices look to be near all-time highs. Now, on the surface, as I mentioned, it looks like US capital markets are roaring. However, looking deeper, not everyone is joining the all-time high party. Let's take a look at a number that we calculate here rather often, which is the Russell 2000 index. So the Russell 2000 index tracks 2,000 small stocks. Basically, it's the smallest 2,000 stocks of the Russell 3000 index, but I guess for simplicity's sake, let's just assume that it is an index that tracks small cap stocks in the United States. And let's compare how small cap stocks have been doing relative to essentially large cap stocks like the S&P 500, Dow Jones, and the NASDAQ. So let's do that right now. Compare the NASDAQ here. We can compare the Dow Jones, and we're going to compare the S&P 500. So a picture is worth more than 1,000 words, and as you can see from this line, the Russell 2000 is not basically participating. It has not made new highs since March of this year. This, a lot of these, the major indices have gone up quite significantly in the same time frame. So why could this be happening? What could explain this, and what could explain why some investors are favoring large cap stocks over small cap stocks, is the fact that smaller companies could have a harder time luring in employees in a tight labor market. And it is interesting to note that essentially, not all sectors of the economy are doing so great within the United States. But again, going back to this concept of pricing power, if we dig deeper into the labor market, we can see some clues as to why small cap stocks are not enjoying the same sort of uplift that the large caps are. And for that, I want to reference a very interesting article that was out this weekend from CNBC, which is that based on last week's unemployment report, it became clear that in the United States now there are about 1 million people. There are about 1 million more job openings than there are people looking for work. So there are 8.6 million people considered to be out of work in the United States, and there are nearly 10 million job openings in the United States. So again, this illustrates how tight this labor market is. Now, these tight labor market conditions will certainly put upward pressure on wages in general. But smaller companies will likely have to dish out even more to lure talent, more than the bigger companies. Therefore, this makes their ability to compete against the more established players in the industry, it's difficult, right? If they have to pay more for the same amount of talent, then it becomes more difficult for the smaller companies to compete against the bigger companies. So, as far as earnings and Fed activity, it's a quiet week in the sort of economic data points and earnings reports. However, we do get that new reading of the US inflation and the CPI this week on Wednesday. More details in our What's Ahead section later today. Moving over to our gold analysis, it was a brutal week for gold last week, finishing down 2.27% for the week, this is the day. Last week, gold finished down 2.84%. And it's basically taking a beating again this morning. We'll go into that one in a bit. But the price action that we saw last week is consistent with the yield in the 10-year note moving higher in the same period. It's up, basically the yield on the 10-year note last week was up quite a bit, up by 3.95% at a yield of 1.28. And the relatively tame wage inflation number out of the unemployment report on Friday basically combined to put a cocktail of conditions that are not favorable to gold. As we mentioned here, when the real return on the Treasury bonds goes higher, bond goes lower. And so what happens when the interest rate on these bonds goes higher, but inflation stays flat, is that the real return of those bonds increases, therefore not favorable for gold. So this is consistent with gold not having a great week last week. However, there's probably more to it given the big drop that we're seeing again this morning. So looking at the technicals, as we highlight here for golds, let's just go back to the gold chart. It seems the gold, on a technical standpoint, it had settled last week right around that trend line, on the top side of that trend line, and it did look like it was going to test it for it to become support, but rather we saw that it actually descended into the lower channel of this trend line. It may even look to go back to this trend line in this area around the 1640 range. Now, the weekly close, the big drop this morning apparently has a lot to do with a big position that was sold early this morning, and this was shared by Eric Felkstein on Twitter, saying that basically somebody sold 24,000 gold future contracts this morning, which basically pushed prices down quite a bit. As far as what could be the driver behind this, some commentary on social media is basically referring to that these types of positions are not typically done by market participants, but rather governments. So it will be interesting to see as more information comes out from this large move in gold, it might be interesting to see some clues as to who's behind them. Moving over to our DeFi analysis, we see that the DeFi, or the FTX DeFi index, actually had a really good week last week, up 12.15%. Ethereum also had a phenomenal week last week, up 17.96% at $3,015. So closing the week over that 3,000 level is quite key for Ethereum, and the chart seems to be pretty pointing in a very positive direction. Some very interesting notes around Ethereum last week came out of the Genesis Capital Q2 lending report, and it was interesting to see a couple of things. So before we go there, one interesting thing to note is that we've seen here that DeFi typically leads Ethereum on the way up, but in this case, we actually saw that Ethereum was leading DeFi on the way up. So quite interesting. It may have something to do with some of the difficulties assessing how the potential regulation will affect DeFi versus Ethereum, which is a much more mature protocol. Now, moving into the insights from the Genesis report, there were a few things that were quite interesting. So from this chart, we can see, from this report, we can see some signs that institutional interest around ETH is not slowing down. Among the interesting insights was the trading volume mix. So as you can see here, it was quite interesting to see that the share of traded volume that Ethereum makes up grew dramatically, more than doubled in the second quarter of 2021 for Genesis Capital. And additionally, if we move to the lending report, we see that ETH went from essentially being 12% of their book in starting Q3 last year to now being essentially 28% of their book. So more than doubled on the lending side and more than doubled on the spot trading side. So these, again, if once you kind of understand the client mix at Genesis Capital, which are basically large institutions, the interest or the appetite around these institutions for ETH doesn't really seem to be slowing down, which is consistent with some of the trends that we've been highlighting here throughout the last few weeks. Now, the regulation will be passed through the new infrastructure bill could certainly impact some DeFi projects and its end users. However, we should also highlight that a path towards this framework itself will also light up a path to compliance, which should help innovation and drive more capital to the space. Moving over to our Bitcoin mining difficulty commentary, we see that mining capacity has actually been roaring back into the network, and the next difficulty adjustment is currently projecting an increase of around 9% in a difficulty. So to put things in perspective, the next adjustment should take us to about 15.5 terahashes in difficulty, and the previous all-time high was around 23, or not around, it was 23.58 terahashes. So we're still quite a bit of ways from the top, but we're slowly crawling back. The next adjustment should happen at some point this Wednesday or Thursday evening, or Thursday morning Eastern Standard Time. And looking at the transaction costs, which you have behind your screen, surprisingly, the transaction costs have remained consistently low throughout the last few weeks, and it continues to be a great time to be transacting on chain. So as always, we leave you with what's ahead for the week. Over the last few months and even year, we have documented how the Fed is actively purchasing Treasury bonds and mortgage-backed securities to keep interest rates low. The intent, of course, is to help the economy improve. The theory is that the Fed will eventually let the markets decide where the rates should be, and these will rise. When interest rates rise, bond prices fall. And this is why some large investors have signaled recently that they might be rotating away from bonds. And for that, we're going to transition and show you the headline that I'm referring to. And the headline came out last week, which refers to the world's biggest pension fund making cuts to its US bond allocation. And as per the article, the allocation is going from about 47% of its portfolio to about 35% of its portfolio. So it's quite meaningful. Now, however, this theory that the Fed will eventually let rates rise and the market will decide where the rates should be doesn't always translate into what happens in the real world. And for this, we can take a look at Japan's example. So let's pop out what happened to Japan's debt. And this is a beautiful chart courtesy of Jury and Timmer on Twitter. What this chart shows is that in order to essentially keep the rates low, the Bank of Japan was not able to essentially let rates rise because the economy was in a bit of a too fragile situation. So what they did is they continued purchasing Japanese Treasury bond debt until the Japanese Fed, or the Japanese central bank, basically came to own over 50% of the total outstanding Japanese debt, which is what you can see right here. And so basically, governments get put into a corner, they can't let rates rise, and they just have to continue buying these bonds so that the market doesn't let rates rise and that the economy continues to add jobs and continues recovering. Now, this is quite interesting and somewhat shocking, to be very blunt. And it begs the question, where is the United States in this regard? So the US has been buying a lot of its own bonds, so where are they in relation to their share of the total debt outstanding? And for that, we can get some data from the Fed to take a look at. According to this data, there are currently about $28.13 trillion in total Treasury debt outstanding. And the Federal Reserve Bank owns 5.27 trillion of that debt, which means that the Federal Reserve Bank of the United States owns 18.7% of the total debt that the United States government has outstanding. If this sounds a bit tricky to you, it's because it is. The United States Federal Reserve Bank owns the United States government's debt to the tune of 18.7%. Still not nearly as bad as Japan, but again, very interesting to see the thresholds and the levels of this ownership. So, as always, we're going to wrap up with a summary of the upcoming economic data and earnings reports that we can expect for the week. So let's flip back to that. So this week, today, Monday at 10 a.m., we get U.S. job openings and also meme stock AMC Entertainment reports earnings. On Wednesday at 8:30 a.m. Eastern, we get the Consumer Price Index and core CPI readings in the United States that we've been talking about. And then on Thursday, we get Producer Price Index, which sometimes tends to lead consumer price indexes. So always important or always good to look for clues in these types of readings. As always, it's a big week coming up, and we'll try to keep you posted right here through the back and through our social media at Huddle with Lennon. If you enjoyed today's show, if you learned something, I welcome you to subscribe to our channel, like it, and share it with your friends. If you don't yet have a Ledden account, I welcome you to check out Ledden.io and learn how you can start earning up to 8.5% APY on your USDC and up to 6.1% on your Bitcoin. We also have the best rates for Bitcoin-backed loans. Check us out. Thank you, everybody. Have a wonderful week, and see you next Monday.